oil prices surged sharply this morning when trading commenced at 10 a.m. Australian Eastern Daylight Time. Brent crude had spiked 12% in the first few minutes of trade before falling back. You can see the live chart here. We're about 6.5 hours into the trading day now. 1 barrel of Brent crude oil currently buying $77.68 US per barrel. So I spoke to Saul, Kavonic, senior energy analyst at MST Financial, a little earlier. He's modelled several potential scenarios outlining what could happen to oil and gas prices in the coming weeks, and some of these predictions are pretty dire.
I think the range that they've been up today is exactly what we were predicting. So if you look at over what's happened in the course of the weekend, the scope and breadth of the strikes was the more severe end than many were expecting, along with the Iranian retaliation, which has been scattered across multiple Gulf states, in addition to Israel, and obviously military and civilian targets, unfortunately there, which has scope to then draw in more actors in the Gulf states into this conflict. Now, what we started to see some noise overnight and early this morning was that some oil tankers have been directly threatened, some of them actually targeted and hit. But what's become a little bit clearer over the course of the day is that maybe that's less of the case. And still, while there's been obviously a lot of targets here, energy transport and energy export infrastructure has not been a primary target yet, and I should stress yet, in the conflict. So as a result, there's no sign of long-term sustaining damage to oil and gas exports. What we are seeing is the passage to the Strait of Hormuz, which accounts for 20% of the world's oil and 20% of the world's LNG. That's the pinch point, and that has dropped to a trickle. Not because there's been direct attacks stopping everything through, but everyone's just being very cautious given the conflict that's going on. And that's going to be holding back so much supply from the market that of itself is going to be a problem unless that is secured and resumes very soon.
Yeah, I think President Trump suggested the conflict could go for at least 5 weeks, could even go longer. So does that mean the Strait of Hormuz right now could potentially be out of action for quite a while?
That is the real risk. And so if you look at just for oil, where you've got up to 20 million barrels a day of oil and oil products withheld, over the course of a month, that's the equivalent of the entire strategic petroleum reserve in the United States, and then some, not being able to make it to market. And perhaps even more acute is on the liquefied natural gas side, where, unlike oil, LNG can't be easily stored. So very quickly, in a matter of days, Qatar will have to start turning down its production if it can't get its ships to take and evacuate the LNG. And if you remember in the 2022 Ukraine war, when Russia turned its gas off to Europe and we saw an energy price shock that went around the world, that was just about 50 million tonnes per annum of LNG. Now we're talking about 80 million tonnes of LNG at risk, plus 20 million barrels a day of oil. We've not seen this much acutely at risk in the market since back in the 1970s when we had the Arab oil embargo and the Iranian revolution. In fact, this could be 3 times bigger than that in the more extreme bookend case. So
have you done some scenario modelling of what could the best outcome be here?
Best outcome, which I mean lower oil prices. If there's a de-escalation very soon, there's about $15 to $20 a barrel of risk premium in the oil price that would come off. What could be potentially even better scenario is if Trump is actually successful in having a regime change to a more moderate Iranian government, which is more welcomed by the global community, that could see investment return into Iran. And Iran has some of the best and lowest cost oil and gas in the world. And that could actually, in the long term, be really beneficial for energy supply and energy prices. Those are the good case scenarios. The bad case scenarios, and they start to get quite extreme, but just at the kind of the low end, partial disruptions to the Strait of Hormuz, even just 10 or 20%. So, for example, if some commercial carriers just say this is too high risk, whereas others are willing to go through, even that could cause a major energy price shock, send oil to $90, $100 a barrel. We could see disruption to Iranian exports of 2 million barrels a day, either because it's attacked, but also just because of disorder within Iran itself, which impacts production. And then the more kind of mid-case scenario is, do we start to see attacks directly on oil infrastructure, not just of Iran, but Iran attacking oil infrastructure of some of its Gulf neighbour states? And then at the more extreme end is the one I talked about before, where most of the volumes for the Strait of Hormuz are impacted. And then we're facing an unprecedented energy shock that we've not seen in generations that would cause a global economic recession.
When you look at all those options, I mean, what seems like the most likely out of those scenarios?
Look, with the caveat, it's a very fluid situation, so the answer to that can change by the minute. But right now, it looks like we should see some kind of return of transit through the Strait of Hormuz, even if it's via the US and its allies will do everything they can to open this, right? So via escorts, but it's not going to get all the way there. So I wouldn't be surprised if we end up in a scenario where we at least got a few million barrels a day off the market. We've got a few million tonnes, potentially tens of millions of tonnes of LNG off the market. And that of itself should see prices elevated, I think more elevated than we're seeing the spot price right now.
And then looking at Aussie oil producers, they're doing very well on the market today, as you'd expect.
Well, Australia's a big exporter, particularly of LNG, and LNG could be impacted in terms of prices going up even more than oil here. So you've seen that reflected in Woodside, Santos Beach, Karoon, all in the share market today. And particularly some of these stocks have been really beaten up and really haven't rallied like other commodities have over the last year. And so they're finally catching a bit of wind on the back of this geopolitical risk. It does go to show how all these pessimistic forecasts, which have been widespread consensus going back a year, can be turned on their head by a geopolitical event somewhere else around the world. And that's why risk skew often is to the upside for a lot of these names, because oil can only go down so much, but when it goes up, it can go up a lot.
Saul Kavonic, thanks so much for your time.
Thank you.